As of 10:08 a.m. Eastern Time, Supermicro Inc., ticker SMCI, is trading live at $35.75 per share. That's a gain of 66 cents, or about 1.88% on the day. The stock has been on a wild ride this morning, opening lower near $34.23 before surging to a high of $36.02, with a session low of $33.69. This is not a calm, orderly bay of trading. This is a high-volume battleground with over 6.2 million shares already changing hands. The common expectation for a company like Supermicro is that it's just another box builder, a low-margin hardware supplier in a commoditized industry, forever in the shadow of giants like Dell or HP. The reality, and what this volatile price action is screaming, is that Wall Street is being forced to reevaluate the entire thesis. Supermicro isn't just a box builder, it's a high-speed custom architect for the exact, power-hungry, liquid-cooled infrastructure that the entire artificial intelligence build-out depends on. The market is in the painful process of realizing this company might be one of the most direct picks and shovels plays on AI in the entire market, and the stock is just now starting to reflect that. This tension is exactly why the stock has been so explosive. Look at the recent past. This name has been hammered, falling over 33% in the last month. That drop was triggered by its last quarterly earnings report, which on the surface looked like a massive disappointment. The company reported first-quarter fiscal 2026 sales of $5.0 billion. This was a 15% year-over-year decline and a 13% sequential drop. It was a huge miss against their own prior guidance of $6 to $7 billion. Adjusted earnings per share came in at $0.35, a fraction of the $0.73 from the year-ago quarter. The market's expectation was that the growth story was broken. The stock plunged, and analysts, including major firms, reiterated sell ratings or initiated with underperform, citing valuation concerns and a broken growth narrative. But that's where they stopped looking. The reality, buried in that same report, was the reason for the miss and the guidance for the future. Management was clear. The revenue shortfall wasn't due to a lack of demand, it was due to a transition. Certain design upgrades, specifically for the new generation of AI chips, pushed massive amounts of expected revenue into the next quarter. This is where the entire story flips. The expectation is that a 15% revenue decline is a catastrophe. The reality is that the company simultaneously raised its full-year fiscal 2026 revenue forecast to at least $36 billion, a huge jump from its prior $33 billion estimate. It also guided for the current quarter, Q2 2026, to be between $10 and $11 billion in sales. That isn't just a rebound, that's a slingshot. The company is telling the market that the miss was a temporary pipeline issue, a traffic jam of demand, not a collapse. Today's trading, with the stock fighting its way back into the green, shows the market is now in a tug-of-war between those who sold on the ugly quarter and the new wave of investors who are reading the beautiful future. This is the kind of setup that creates massive swings, the kind of name that active investors on platforms like Interactive Brokers or Fidelity's advanced trading desks are watching, while a passive observer on a simple Robinhood app might have only seen the initial crash and looked away. This isn't a stock for a passive Schwab Intelligent Portfolios account. It's a high-conviction play for a self-investing individual who's willing to do the homework. So, what does Supermicro actually do that makes it so special? The expectation is that they just assemble motherboards, processors, and memory into a server case. The reality is their building block solutions business model. This is their entire competitive advantage. Instead of designing massive monolithic systems that take 12 to 18 months to update, SMCI designs and manufactures a huge portfolio of modular interoperable components, motherboards, chassis, power supplies, cooling systems. When a new chip, like NVIDIA stock's latest Blackwell GB300 or AMD's new MI350X, is released, Supermicro doesn't have to go back to the drawing board. They can use their building blocks to assemble a new, optimized, and validated server solution in weeks, not years. This speed to market is everything. In the AI arms race, hyperscalers and data centers cannot wait for 18 months. They need the newest, most powerful chips racked and running now. Supermicro is, in many cases, the only company that can deliver that. This brings us to their second and perhaps more critical advantage: liquid cooling. The next generation of AI processors are so powerful that traditional air cooling is no longer sufficient. They are generating immense heat. Supermicro has invested heavily in designing and building full-scale direct-to-chip liquid cooling solutions, from the cold plates on the chip to the in-rack coolant distribution units. They are now offering this as part of their new data center building block solutions, allowing a customer to design an entire data center, from the server racks to the networking and the high-powered electrical components, all from a single vendor. This is the key. The $5 billion miss was in part due to the complexity of integrating these new rack-scale liquid-cooled designs for a massive new customer win. In their earnings call, the company explicitly stated it has over $13 billion in back orders for its NVIDIA Blackwell Ultra product line, including the single largest deal in its 32-year history. This is the reality that the market is struggling to price. The company is transitioning from selling individual servers to selling entire prefabricated, liquid-cooled AI data centers. This is a very different business from Apple stock or Tesla stock, which are bets on consumer products and ecosystems. This is a pure infrastructure play, and it's not without its critics. The bear case is clear and present. First, margins. In that last disappointing quarter, the gross margin was 9.3%. Management has guided that margins in the current quarter will compress even further, by about 300 basis points. Why? Because these massive new design wins, while huge for revenue, carry higher costs and lower initial margins to secure the relationship. The company is buying market share, and that's expensive. This is a legitimate concern for anyone running a traditional valuation model, perhaps within Fidelity Investments' research department. Second, there's massive customer concentration. A huge portion of their business is tied to a few very large hyperscale and data center clients. That's fantastic when demand is high, but if one of those clients decides to double source or hits a pause on spending, SMCI's revenue could fall off a cliff. This is the central conflict. Comment below. Do you see this high customer concentration as a sign of deep, sticky relationships with the biggest winners in AI? Or is it just too much risk to have all their eggs in a few giant baskets? Finally, there is the execution risk. Guiding for $36 billion in revenue is one thing, delivering it is another. They are ramping up production, building out new facilities, and managing an incredibly complex global supply chain. Any hiccup, a component shortage, a manufacturing delay, and they will miss their numbers again, and the stock will be punished, likely far more severely. This is not a set it and forget it investment for a Fidelity IRA. This is an online investment that requires active monitoring. You need to be watching the supply chain news, listening to commentary from their chip partners like NVIDIA and AMD, and tracking the capital expenditure plans of the big cloud providers. This is the kind of name where you use the Fidelity mobile app to set alerts, not just to check your balance. Looking forward, the bull and bear cases are perfectly balanced on a knife's edge, which is why the stock is so volatile. The bull case is that the ugly first quarter was the last gasp of the old company, and the $10 to $11 billion Q2 guidance is the birth of the new one. The bulls believe the market is making a huge mistake by valuing SMCI on its trailing compressed margins and not on its future, where it becomes an indispensable partner to the AI industry with a growth rate that should command a NVIDIA stock-like premium. If they execute, the $36 billion in sales is just the start. They are already designing for the next generation of chips, like NVIDIA's Vera Rubin and AMD's Helios. In this scenario, the stock's 52-week high of $66.43 is just a waypoint. The bear case is that the company is a victim of its own success. The $36 billion in revenue will come, but at the cost of permanently destroyed margins. They are in a low-margin hardware business, and competitors will catch up. They are taking on massive execution risk, and the market is right to be skeptical. They are too dependent on a few large clients and the boom and bust cycle of data center spending. In this view, the stock is a value trap, and the recent low of $33.69 is a sign of more pain to come. As we watch Supermicro fight to hold its gains today at $35.75, the story is clear. The expectation is that this is a broken growth hardware stock. The reality is that it might be one of the most misunderstood and aggressive growth stories in the entire AI infrastructure space. The stock's violent 33% plunge, followed by this ferocious battle to find a bottom, is the